Alright, so in this lesson, we're going to be looking at how do you trade by spotting divergence patterns. As you know, one of the most important things as a trader is to identify changes in trends, changes in price movement. And what you've learned so far is you can identify a change in trend by using moving averages. But what if you could anticipate a change in trend way before it happens? Well, just before it happens. And you can. And the way you do it is by looking for divergence patterns between price trends and indicator trends. So what does this mean? Now, a divergence means conflict, which means a difference, okay? So we're looking for conflicts in the trend of the price and the trend of one of the indicators. You can use any indicators to spot divergences. In this case, we're going to focus on one of the main indicators, which is our MACD, moving average convergence divergence, with a setting of 12, 26, and a 9 EMA. So let's understand how this works. Basically, there are two kinds of divergences: bearish divergence and bullish divergence. All right, and well, let's look at bearish divergence. So first of all, when do we look for bearish divergence? Bearish divergences occur at the top of uptrends. All right, so whenever you're at the top of an uptrend, you look for a potential bearish divergence that anticipates that price is going to come down. Okay, so in this case, you can see that it is an uptrend. Why? Because price is making higher highs, like so, and higher lows. Okay, and at this point of time where I'm pointing, it is at the top of the uptrend. So at the top of the uptrend, we're anticipating, will it continue going up, or is it going to reverse? So we're looking for a bearish divergence indication that it's going to reverse down. All right. Now, for bearish divergence, we always connect and compare swing highs on the price and swing highs on the indicator. So what are swing highs? Well, swing highs are the high points. For example, this is a swing high. All right, let me just clear that and draw it again. This is a swing high. This is a swing high. That's a swing high. Okay. So what we want to do is we want to connect swing highs with lines, right? So for example, we connect this swing high to this swing high. Okay. We connect this swing high to this swing high. Now, one of the important rules is when you connect swing highs, they can't intersect any price patterns in between. It's going to be a clean connection, right? So once we connect swing highs, we are seeing that it's making higher highs, right? Now what we like to see is on the indicator, the corresponding indicator, it is making lower highs. So there's a conflict, and we're going to see that in the next slide. So just hang on there for a while. Just understand at this point of time that for bearish divergence, we look for them at the top of uptrends, number one. And number two, we will connect and compare swing highs in order to spot these divergence patterns. All right, so just hold that thought for a while. Okay, great. The other kind of divergence we're looking for would be bullish divergence. So bullish means we're anticipating the price will go up. Okay, so when does this occur? This occurs at the bottom of downtrend. So whenever we're at the bottom of a downtrend, we are looking for a sign of a bullish divergence. The price will reverse back up. Okay, so in this case, you can see on the chart, it's a downtrend. Why? Because it's clearly making lower lows, right, and lower highs. Okay, and at this exact point of time where I'm pointing, it is the low of the downtrend. Okay, so at the low of the downtrend, I'm looking for a bullish divergence. For bullish divergence, I connect and compare swing lows. Okay, remember that for bearish divergence, we connect and compare swing highs. But for bullish, it's the swing lows. Now, this is something you just have to memorize. Okay, it's just something you got to know. Okay, so again, where are the swing lows? This is a swing low. This is a swing low, this is a swing low, that's a swing low. So swing low are the lowest points, okay? So we're going to connect the swing lows together. So we can connect this low to this low. We could connect this low to this low, right? So it doesn't matter as long as you connect any two swing lows, that doesn't intersect any price in between. Right? So connect this swing low to this swing low. And what we want to see is that the corresponding indicator, which I'll show you in a while, is making an opposite trend. So on a downtrend, it's making lower lows. We want to see the indicator making higher lows. Hence, there's a divergence telling us that there's going to be a potential reversal in the price. All right. So let's take a closer look at what I'm talking about. Let's take a look at the bearish divergence pattern. Now, understand that these are reversal patterns because we're anticipating a reversal from going up to going down. So it's a reversal, all right? So in this case, you can see that the price is making higher highs, right? So it's higher high, higher high, higher high, okay? So at this particular point over here, it's the top of the uptrend, okay? So let's imagine that you have not seen this yet, right? So this is the future. We are here at this moment in time, okay? So we are at the top of the uptrend, right? So remember, at the top of the uptrend, what do we look for? We look for a bearish divergence because we're looking for it to go down, bearish, okay? So we connect swing highs. So we will connect this swing high to this swing high, right? And we connect it together, we can see it's making higher highs, okay? So we then look at the corresponding swing highs on the indicator, which is in this case the MACD, right? So if I were to imagine a dotted line going down, it's going to be vertically aligned. So this swing high on the price corresponds to this swing high on the MACD. Can you see that? Swing high. And this swing high on the price corresponds to this swing high on the MACD. So do we have a divergence? Yes, we do, because on the price, it's making higher highs, right? But on the MACD, it's making lower highs. So there's a conflict or a divergence. And the moment you see that divergence, you're going to anticipate that price is not going to continue going up. It's going to come down, all right? So over here, we anticipate that it's going to go down. So what we do, we sell, right? So if you're already in a long position, obviously you want to sell once you see a bearish divergence to take your profits off the table, okay? If you're not in a position, you could do a short sell. So you short at that point over here, okay? As you short and it comes down, you are making a profit, all right? But because, again, you are doing a counter trend trade, you're selling against the uptrend, right? You're selling, taking advantage of that retracement. So you gotta know when to buy back to cover your short position before the uptrend continues. And when we look at that in a while, all right? So when would you enter this sell position? So what I do is this. Now, again, question you may have would be, now, how do I know that this is a swing high? How do I know that this is a swing high, right? Well, you know that this is a swing high because it is making a higher high than the previous candle and the next candle. Can you see that? So imagine like a V shape, okay? So this high is higher than this high and it's higher than this high. So that makes it a swing high, okay? Again, how do you know that this is a swing high? Because this high is higher than the previous high and higher than the next high. So you would only know that this is a swing high only after that this candle has closed, right? Before this candle closes, you will not know that this is a swing high, because if this high, or rather if this candle made a higher high than this candle, then this would be the swing high, right? So you never know when it's a swing high until the next candle closes. And only when the next candle closes the lower high do you know that, wow, that's a swing high, okay? So when this candle closes, you know that's a swing high, and you can proceed in connecting those 2 points. And again, you vertically go down and see that, hey, is the indicator making an opposite direction, right? Higher highs and lower highs. Now, before I do a short, I also want to see that I have some kind of bearish candlestick pattern. It's not good enough to see a divergence. I also want to see a bearish candlestick pattern that tells me that the candles reverse. So the ideal would be to see, for example, a bearish pin bar. So you can see that this is a bearish pin bar, right, with a long upper shadow and a small candle body. So the moment I see that bearish candlestick pattern with a bearish divergence, it's enough confluence for me to take a short trade. So what I'll do is I'll put a sell order a few cents below the low of this candle, right? Could be like 3 or 5 cents below the low of this candle, and a stop loss a few cents above the high of that candle. Okay, so this would be my entry, which would be a sell stop limit order. This would be my stop loss. Okay, so this would be my risk of 1R, right? Because if the price were to go up and it hits my stop loss, I'll lose that 1 hour of risk. Okay, so to make it worth my while, my profit target has to be at least, that's right, 2R, 2 to 1, right? So the next day, the price goes down as I anticipate, triggers my sell order, proceeds to go all the way down and hits my target price, getting a 2R in profit. Here's another example on CABO, right? So once again, you see that price is on an uptrend. Okay, so it's making, you can see, higher highs, higher lows, and at this point over here, okay, is where we are looking at. Okay, so that's a swing high, and again, you will know that's a swing high only when this candle closes. So you can see that this candle makes a higher high than the previous candle and a higher high than the next candle. So that's a swing high. Okay, and over here would be a previous swing high. Now, this is a swing high as well. So you could have connect this to this or connect this to this. It doesn't matter. As long as you connect any two swing highs that doesn't intersect any price patterns in between, it's a valid connection. All right. So in this case, I like to connect this swing high to this swing high. Okay, so it makes higher highs. Now, correspondingly, I vertically look down and look at the swing high on the MACD, which is over here. And again, vertically look down, that's a swing high on the MACD. So I want to see that as price is making higher highs, MACD is making lower highs. That's a divergence, that's a conflict. So in this case, you can see price making higher highs, MACD making lower highs. So that tells me that the price has a probability of reversing down. And again, I do not just want to see that, I want to see a bearish candlestick reversal pattern to add added confluence to my trade. And sure enough, guess what? That is a bearish pin bar. Okay, with a small candle body with a long upper shadow, telling us that bulls, or rather bears have taken control over the sentiment of that stock. All right. So where would I place my entry? Or if I want to anticipate a short position, I would place my entry once again. I'll put my sell order a few cents below the low of this candle. Oops, hold on for a while. A few cents below the low of this candle, right? And my stop loss would be a few cents above the high of this candle. So once again, that's my entry price. That is my stop loss price. Okay, and that is my 1R of risk I'm taking. So again, I want a price to be able to go down to at least 2R and take a profit of 2R. All right, so the next day the price goes down, it triggers my sell order, it goes all the way down, boom, I'm out of trade, I've got a 2R win. Okay, so that's how we trade the bearish divergence pattern. Alright, so now let's move on to the bullish divergence reversal setup. So for bullish divergence, again, we look for it at the bottom of a downtrend, okay? And we connect the swing lows on the price trend and compare them with the swing lows on the indicator trend. So let's take a look at this chart over here on the SPY. You can see that it is on a downtrend, okay? And at this point over here, it's at the bottom of the downtrend, all right? So we are looking for a bullish divergence pattern. So what we do, we connect swing lows, all right? So this is a swing low, and we connect it to this swing low. Now again, the question would be, why couldn't I connect it to this swing low, or this swing low, or this swing low? Okay, sure, you could connect this swing low to this swing low, right? You could do that, right? You could connect this swing low to this swing low, but you couldn't connect this swing low to this swing low. Why? Because if you connect this, it would intersect prices in between. So remember, the rule is as long as you connect two swing lows without intersecting any price, that's a valid connection, right? So we could connect any of these swing lows together, right? But you would have to see that the corresponding MACD is making a conflict or a divergence in the trend, all right? So in this case, I connect this swing low to this swing low, and I then look at the alignment and the corresponding swing low on the MACD, which is in this case here, all right? This swing low here would correspond to this MACD swing low over here. So you can see that price is making lower lows and MACD is making higher lows with no intersections in between. So that's a divergence pattern. So the moment you see that divergence, again, we're anticipating that price will start reversing back up, okay? And we want to see some kind of bullish candlestick pattern, like a bullish pin bar or a one white soldier or bullish engulfing pattern, some kind of candlestick pattern that adds additional confluence to a change in the price movement. So in this case, you can see that this again is a bullish pin bar, right? With a small body and a long lower shadow. So we could put again a buy order a few cents above the high of this candle. That would be our entry. Okay, and our stop loss a few cents below the low of this candle. That would be our stop loss. And this would be our risk, our 1R, which is the difference between the entry price and the stop loss price. So our profit target would be somewhere over here, at least 2R of profits, right? Our take profit, TP. So sure enough, the next day, the price goes lower. It doesn't trigger our buy order, but it does not make a lower low, right? So that's how we know that this is a swing low. So we only know this is a swing low when this candle has closed. So that confirms a swing low, right? So the next day, what happens? The price goes up, triggers our buy order, and we're in the long trade and hits our take profit over there. Okay. Now, again, let me answer a question some of you would have would be, so why wouldn't I have connected this swing low to this swing low, right? Well, you could have, right? So if you connect this swing low to this swing low, again, this is supposed to be straight, right? You would then have to connect this swing low on the MACD to this swing low, all right? So connect this to this. So is there a divergence from these swing lows? No, there isn't, all right? And that's why I did not make those connections, because there is no divergence that exists. But from this swing low to this swing low and this swing low to this swing low, there is a divergence. Okay, so you are looking for swing lows that have a divergence. As long as there's a divergence that exists, that's a valid trade. All right. Okay. So let's take a look at one more example of Goldman Sachs. All right. So once again, price is on a downtrend, and we're looking at the low of the downtrend, the lowest point, which would be here. This candle is the lowest point. Okay, so this is a swing low. And again, you would only know that this is a swing low when the next candle has closed with a higher low. Okay, so that confirms a swing low, and we are connecting this to another swing low. So we connect it to this swing low. Again, could we have connected it to this swing low? Sure, that's valid, right? So could it connect this swing low to this swing low as well? Right, again, this is supposed to be a straight line. That's a valid connection. But if you were to do that, what would have happened? You would connect the swing low on this MACD to here. Now, this is not a valid connection. Why? Because if you connect these two swing lows, it would intersect the indicator over here. Remember, when you connect swing lows or swing highs, they cannot intersect anything in between. So this would not be a valid swing low connection. But you can see over here, connecting this swing low to this swing low, it doesn't intersect any price in between. Connect this swing low to this swing low, does not intersect any price in between. Voila, it's valid. All right. So there you go. Price makes lower lows, MACD makes higher lows. We have a divergence pattern. Again, this is a bullish pin bar, which again gives us added confidence that price is likely to reverse up. So our buy order is over there, stop loss over here. So this would be our entry price. This would be our stop loss. Okay, and that's our 1 hour target or 1 hour risk. Okay, so we need to have a target price of somewhere over here, 2 hour. Okay, that we reached somewhere over here. Okay, so this is a bullish divergence pattern. All right, so now let's take a look at some charts and see if you can spot these bullish or bearish divergence patterns. All right, so now you understand the concept of bullish and bearish divergence. Let's see if you can spot them on some price charts. So what I have over here is the price chart of Coca-Cola, and I'm looking at the last 5 years daily candles. All right, so the first thing to do is to put in one of the indicators I can use to spot divergence patterns. So I'm going to use the MACD for the indicators. So I'm going to go to Studies. Whatever charting software you use, you can insert the indicators or the studies that you like. So I'm going to apply Studies, and I'm going to choose MACD. So you could choose MACD with 2 lines or with the histogram and 2 lines. It's really a matter of preference, right? So I'm just going to choose the histogram with 2 lines. And you have to configure the settings. I'm going to double click on that. And fast period 12, slow period 26, signal period 9. So click OK. There we go. So what we have here is we have the MACD indicator below the price chart of Coca-Cola. So I'm going to zoom back. I'm going to go back 5 years in time. Let's say we zoom back somewhere over here. And I'm going to move the candle on the right, 1 candle at a time, kind of like 1 day passing at a time. And let's see if we can spot any potential divergence patterns to take a trade on. Okay, so recall that when we're at the low of a downtrend, I'm looking for a bullish divergence pattern. When we're at the high of the uptrend, I'm looking for a bearish divergence. All right, so I'm going to scroll to the right and I'm going to see if we spot any of these patterns that come out. All right, so scrolling down. Okay, what do we have here? So you can see that over here, we are at the bottom of a downtrend, all right? And that's a swing low, okay? This is a swing low. So I'm going to connect this swing low to this swing low. And correspondingly, I'm going to align it and find the swing low on the MACD and connect it to the swing low over here. There we go. So price is making lower lows, MACD is making higher lows. That's a bullish divergence, all right? But like I said, I like to see some kind of bullish candlestick pattern in addition to the divergence to give me more confidence to enter the trade. So in this case, I do not have a bullish candlestick pattern like a bullish pin bar or a bullish engulfing pattern. So I'm going to give this a miss. All right, so I'm looking for another pattern to emerge. Okay, so right now what has happened is that price has made another low and divergence has also made another low, okay? Or rather the MACD has made another low. So let me see if I can find another pattern over here. So now we connect this swing low to this swing low and this swing low to this swing low, right? And you can see there is a slight divergence, right? Price making lower lows and MACD making higher lows. We're at the bottom of a downtrend, and this is the swing low. Now, following that, we have got a bullish engulfing pattern. So that's gotten me interested, right? So this candle, the entire body engulfs the body of this candle. That's a bullish candlestick pattern with a bullish divergence. So this is a valid pattern. So I'm going to place my buy order, say 3 cents above the high of this candle, right? So the high of this candle, as you can see, it's 36.83. All right, so I'm going to put my buy order at 36.86. All right, let me just note it down. Okay, it's roughly about 36.86, somewhere around here. Okay, and a stop loss would be at the 3 cents below the low of this candle. The low of the candle is 36.20, so 36.17 would be my stop loss. 36.17 there. Okay, now if you're wondering how I know the high and low, if you take a look at this L, that's the low, and that's the high. So when I point at a candle, the high and the low of that candle will appear. That's how I know the high and the low. All right, great. So let me just write that down. So the entry price again is 36. Oops. Just confirm that. So the entry price 36.86. 36.86. That's my entry price. My stop loss is again 3 cents below the low of the candle, 36.17. So 36.17. Great. So what is my risk per share? My risk per share will be 66 cents. Okay. So 1 hour of risk is 66 cents. So my profit target has to be at least 2 times the risk, which is 132, right? 66 cents times 2 is 132 plus my entry price, which is 36.86. So my target price is 38.18. All right, so my target price would be $38.18, somewhere over here. There we go. All right, great. So let's see what happens. The next day, the price goes up, triggers my buy order at 36.86, and let's see if we can hit my target price of $38. And there we go. All right, so 1, 2, 3, 5 days, I hit my profit target, and I'm up 2R on this trade. Let me just write it down, 2R on this trade. Okay, so with that, let's move on, and we can see. So that was a bullish divergence. That was a long entry I took to write the price up really quickly and take a quick profit. Let's see if I can find another pattern that emerges. All right, actually this was a bullish divergence, but I couldn't catch it, right? You can see again, this price makes lower lows, right? And MACD makes higher lows. Now this is a very strong divergence. You can see swing low to swing low, right? Lower lows, higher lows. Now, but the trouble is, right after this swing low candle, boom, the next candle was too high, so there's no way you could have caught it to take the trade, right? So even if you see it's going up, but you may not always get it, because by the time this candle appears and confirms a swing low, the price would have moved up too high. It's too late to get in, so that would not have been a valid trade, right? So let's see if there are any more valid trades around. Okay. As you can see now, we are at the high of the uptrend, so I'm looking for price making higher highs and MACD making lower highs. But I don't see that because I see price making higher highs and MACD also making higher highs. So there's no divergence. I'm going to keep scrolling till I find a clear divergence. All right. Again, no divergence. Price makes higher highs. MACD makes higher highs. Moving on. Moving on. think I scrolled too fast, sorry about that. Okay, now I did spot a divergence here. Again, it was a bit too fast. You connect this swing high to that swing high. All right, so that's making higher highs. And correspondingly, the MACD is making, that's right, lower highs. So there is a slight divergence there. And again, this looks like a bullish, bearish pin bar candle, right? With a small candle body and a long upper shadow. So you could take a potential trade. You could put a sell order a few cents below the low of that candle. Again, 3 cents below the low. The stop loss could be just above the high as we calculated in the past. So that's my entry, that's my stop loss. My target price will be somewhere here, right? About 1 to 2, okay? So let's see the next day, boom, price goes down, triggers the sell order, sell stop limit order, goes down, and that's it, right? Nicely hits the profit target, getting another 2 hour in profit very quickly before the price went all the way up again. All right. So you can see that by shorting here, we are again selling against the uptrend. So it's a counter trend trade where you have to be able to get out quickly before the uptrend continues. All right. Okay, so let's see if I can spot any more patterns going on. Okay, there we have it. All right, so here's a clearer pattern. Price makes higher highs. Okay, so that's a swing high over there. Now, I do not know that this is a swing high yet. I do not know because, well, it's a bearish pin bar, all right? But I have to wait for the next candle to close to confirm that this is the highest high. Because if the next candle goes higher than this candle, then, well, the next candle becomes the highest high, right? So I gotta wait for one more candle. There you go, all right? So the next candle closes, this is indeed the swing high. So price makes higher highs, corresponding MACD makes lower highs. Now this is the kind of divergence that I like because you can see a very clear, distinct conflict in the price trend going up and the MACD going down, all right? So once I have that, I can put my sell order, again, a few cents below the low of that bearish pin bar. I could put my stop loss just above the high of the pin bar. Okay. Now I could also put my stop loss. I could also put my entry below the low of this candle as well. Right? I could do that. Right. In fact, yeah, that would make more sense. Let me just do that. There we go. Okay. So the next day, if the price continues going down, you get triggered. All right. So that's my 1R in risk. My profit target will be somewhere, I guess, around over here. Right. Risking 1 to make 2. So I'm going to do a short. Again, I'm shorting against the trend, so I got to exit before the trend continues. Let's see what happens next day. Boom. It goes down as I anticipate, triggers my sell order, my sell stop limit order, and let's see if it goes all the way down. Oops. Yes, that's right. Okay, here's my profit target. Boom, I'm in it for another 2 hour in profit. Oops, I just cancel all that. But well, total of 6 hours so far. I'm just going to write that down. 6R out of 3 trades that I took. Okay, great. So moving on, let's see if we can find any more trades. So we have seen so far one bullish divergence and one bearish divergence, right? And again, I hope you can see how I identify them, right? When it's at the bottom of a downtrend, I'm looking for a bullish reversal. At the top, I'm looking for a bearish reversal. I'm always looking for the opposite to happen. And seeing if the MACD shows an opposite signal. Okay, so as you can see, price is making a lower low, but MACD is making a lower low, so there's no divergence here. I'm going to move on. Again, no divergence here. Let's see if I can find another one. Okay. So I see a potential divergence, right? Price makes a lower low, MACD makes a higher low. There we go. Very clear, right? So we're at the bottom of the downtrend again. So I connect the swing lows, anticipating a reversal up. Corresponding MACD is having a divergence. Okay, so that's a bullish pin bar. Very nice. Again, I could enter the trade right away, but we could wait for the next candle to appear. Oops. Yeah, luckily we waited for the next candle to appear. So you can see, the moment the next candle appears, it shows that this is no longer the swing low, right? That's the swing low, okay? And anyway, even if you put your buy order 3 cents above the high of that candle, you will not have gotten triggered because the price never went up anyway, right? So that is not a valid trade. We never would have gone in. Let's move on. Oh, another bullish pin bar. Great. So now let's connect this low to this low, this low to this low. All right. So let's wait for the next candle. Okay, again, bullish pin bar. I could put a buy order immediately above the high of that candle to be more aggressive if I wanted to. Stop loss below there. Right, and again, my target price would be somewhere here, 1:2. Let's see what happens. Next day, boom. Okay, so you can see I was a bit aggressive and I got stopped out because the next day the price went up, hit my entry, I bought it, and boom, I immediately hit my stop loss, right? So that's the danger of being aggressive, of not waiting for the next candle to confirm that that was a swing low, right? So I lost 1 hour from that, being too aggressive, okay? All right, so I got 3 winning trades and 1 losing trade over there, okay? So again, if you were more conservative, you would not have taken that trade because this would not have been a swing low if you had waited for the next candle to confirm, right? Negative demonstration, but good lesson to show you what happens when you're not paying attention. Okay, now here's another potential entry. Once again, we have got that. So if we now treat this as the swing low, we could connect this and correspondingly connect the MACD. So we still have a bullish divergence, right? And now what do we have? We have, after the swing low, a bullish candle that confirms that this is a swing low, right? So that makes a higher low, and that makes a higher low. So this is a confirmation, right? Do I have a bullish candlestick pattern? Not really. There's no bullish engulfing. There's no one white soldier. So it's a bit more risky. So I may not take this trade, but let's see what happens. Let's see if it goes up from this bullish divergence. Right, comes down again. Oops, goes up, goes up. Wow. Okay. So this would have been a winning trade, as you can see, but I wouldn't have taken it because it was a bit risky. There was no strong bullish candlestick pattern. So this can show that sometimes you may take a trade that meets all the rules and it doesn't go your way. And sometimes you can not take a trade because it's risky, but it ends up winning, right? Doesn't matter. As long as you keep taking trades that meet the criteria, right, over time you would have more wins than losses, right? And this is how I look for divergence patterns on charts. Okay, so let's see if we can find one more pattern, right, so that you really understand how to do that. All right, so moving on, let's see if we can find another pattern. So you can see price is now moving up. So as it's moving up, what am I looking for? I'm now looking for a bearish divergence, right? So it's going up, looking for it to come down. If it's going down, I'm looking for it to come up, right? So these are all counter trend trades. I'm trading against the trend. And that's what divergence reversal patterns do, okay? Okay, let's see. Oh, right. So I just spotted, can you see that this is a bearish pin bar? So whenever I see a bearish pin bar at the top of an uptrend, I get interested, okay? And I want to see some kind of divergence to confirm that it was going to retrace down, okay? So let's take a look. I can connect this swing high to this swing high, but I have to match it with the MACD. So I think this is a good one, okay? So I'm going to connect this swing high over here to there. Sorry. So price making higher highs, and I can see the MACD, it's now going down. Can you see? So price makes higher highs, MACD is making lower highs. Now, I know it's a slight divergence, but it's a divergence nonetheless, all right? And we've got a bearish pin bar over there. So again, if I want to be aggressive, I could put my entry price a few cents below the low of that candle, and my stop loss a few cents above the high. So that is my entry, sell stop order, stop loss there. That's my 1 hour risk. So my target price will be somewhere about here, 1 to 2. So let's see if it comes down. Next day, boom, that's right, price goes down, hits my sell order. I'm in the trade. Let's see if it goes down. There we go, boom, very nice. Goes down, hits my target price. I'm in it for another 2 hour in profit. All right. So far you can see I made 5 trades. I had 5 trades. I had 4 wins and 1 loss. When I lose 1 hour. When I win 2 hour. So that's how you book a profit over many trades, right? So that concludes this part of the lesson on divergence patterns. I'll see you in the next lesson. Alright guys, so welcome to this lesson on market and sector analysis. One of the common mistakes that amateurs make in trading is they don't understand the state of the market in which they're trading in, or the state of the sector in which the stock they're trading belongs in. And that is why sometimes you may see a stock with a great setup and you go in and the price doesn't move, even though there's a bullish candlestick pattern or it bounces off the moving average or some indicator tells you that price tends to move up. And the reason is very simple, because the overall market is going down, or the stocks in a sector is going down. Because one of the things you got to understand is that increasingly stocks are getting more and more correlated. In other words, stocks tend to move together more often than not, right? In fact, 70% of a stock's short-term direction is influenced not by the company itself, but it is influenced by the overall market trend and the sector or industry trend that the company is in. So when we go long on stocks at a time when the market and the respective sector trend is up, it gives us the highest probability of success. Conversely, if we go short on stocks when the market is bearish and the respective sector which the stock is in is bearish, that's the highest probability that we're going to have a winning trade. So if we take a look at this diagram here, you can see that again, 3 out of 4 stocks, or 70% of stocks, will move in the direction of the S&P 500, which is the index that represents the whole market, and 3 out of 4 stocks will move in the direction of the sector or industry. Okay, similarly, it's the same, it's true on the short side. Okay, see, the market is divided into different sectors and industries. Okay, and money flows between sectors. So for example, when money flows into the technology sector, is many of the big funds are buying technology stocks. What happens? That's right. You find that a rising tide lifts all boats, or most boats for that matter. So when the technology sector is in rotation, that means money is flowing in, what happens? Almost any technology stock that you buy is going to go up, right? Even the lousy ones, okay? Now, when money flows into the technology sector, it has to come from somewhere, right? So for example, it came from the healthcare sector, which means healthcare sector is out of rotation. Money is flowing out of healthcare sector, and you find that most of the companies in the healthcare sector will go down, or even the good companies, right? So again, there's no point analyzing how good a company is or how bullish the stock is unless you know that it's in a sector or an industry that's in rotation, that is bullish as well, and in an overall market that's bullish if you're going long, okay? So the first thing to do is, when you decide what to trade, is to look at the general market, okay? So the general market is represented by the index. So for example, if you're trading US stocks, you're looking at the US index. The main index would be the Dow Jones, the S&P 500, the NASDAQ, and maybe even the Russell 2000 small cap index. If you're trading, for example, Hong Kong stocks, you want to look at what the Hang Seng index is doing. Trading Singapore stocks, you have to look at what the Straits Times index is doing. Okay, so primarily I swing trade US equities, US stocks. So the first thing I do every day is, what do? Yeah, I look at the S&P 500. What is the trend of the S&P 500? Okay, is it an uptrend or is it a downtrend? If it's an uptrend, I will tend to look for stocks to go long and avoid shorting. If the whole market's on a downtrend, I look for stocks to short. Now the next question to ask would be, okay, which trend are you looking at? The long-term trend, the medium-term trend, or the short-term trend? Well, the type of trend that you follow depends on, again, your time frame as a trader. Now, if you're a swing trader, which means you hold your position for a couple of days, then you're looking at the short-term trend of the S&P 500. And the short-term trend is measured with the 20 exponential moving average, or the 20 EMA. The 20 EMA is a benchmark for the short-term trend. Now, if I'm more of a medium to long-term investor, okay, I don't really care about the short-term trend. I'm looking more at the medium to long-term trend. And for that, I use the 50 moving average as reference to the medium-term trend. And for the long-term trend, I look at the 200-day moving average. Okay? So in other words, if I'm a short-term trader, which I am, okay, I will see if the price of the S&P 500 is above or below the 20 EMA. Okay? If the price is above the 20 EMA and the 20 EMA is sloping up, it's a clear short-term uptrend. So I will look for stocks to go long. Now, if the price is below the 20 EMA and the 20 EMA is sloping down, I'm not going to go long because I'm going against the main trend. I'm going to go short. So I'm going to look for stocks that are on a downtrend while the market's on a downtrend. Does it make sense? Great. And again, if you're more of a medium-term or long-term investor, as long as the price is above the 50 moving average and the 50 MA is sloping up, you could take a medium-term investment. And if the price is below the 50 moving average and sloping down, you do not want to take any kind of long investments. All right? So take a look at this period of time, and this was during the financial crisis. So you can see that during this period of time, the red line you see here, that's the 200-day moving average. So that measures the long-term trend. And you can see that throughout this entire period, the price of the S&P 500 was below the 200 moving average. And the 200 moving average is sloping down. So in that situation, I can tell you that 70% of companies will have their price going down almost every day. No matter how good the company is, no matter how undeveloped, it's going down because the whole market is going down, all right? And you can see that in this period of time, the 50 moving average, the blue line, is also sloping down and is below the 150 moving average. And so that is a clear medium-term downtrend. So you would not want to take any long-term investments during this period because if you buy, I can tell you that chances are whatever you buy is going to go down. All right, and cheap is going to get cheaper. Okay. Now, as a short-term trader, I'm looking more at the red dotted line that you see here. Okay, so you can see the red dotted line tends to change trend faster because it's a short-term trend. It measures the last 20 trading days of the market. Okay. So overall, over here you can see during this period, when price was below the 20 EMA, all right, what will I be doing? That's right, I'll be looking for short trades, looking for short setups. I will not take long setups because chances are they will not hit their target price. And now overall, over here, what has happened? You can see the 20 EMA, excuse me, has reversed from sloping down to sloping up. So at this moment, the moment the 20 EMA slopes up and the price is above the 20 EMA, I am in a clear short-term uptrend as far as the index is concerned. So over here, I will start taking long trade setups, right? Capitulation, long Bollinger Mean Reversion setups over here. All right, so that's the first thing you look at is the trend of the overall market. All right, so once you know the trend of the overall market, the next thing is to look at what is the sector trend, what's the industry trend. Remember that stocks within a sector and specifically within an industry tend to move together as well. The market is divided into about 10 sectors. So these are, example, the consumer discretionary sector, consumer staples, energy, financial services, financials, healthcare, industrials, materials, real estate, technology, utility. So these are the 10 main sectors. And again, money flows between sectors, right? And when institutional money flows into a sector or an industry, 75% of stocks within that sector or industry will move up. All right. Similarly, when money flows out of a sector, 75% of companies in that sector will go down. So if you want to go long on a stock, you want to make sure that stock is in a sector that's going up. All right. Because if the sector is going down, I don't care how strong the stock is, how strong the trend is, the overall sector is pulling it down. Okay. At the same time, if I want to short a stock, it's best to short it when it's in a sector that's moving down. Now, an industry is a subset of a sector. For example, in the financial sector, it's divided into several industries, like the banking industry, or the insurance industry, or the mortgage industry, or the stockbroking industry, right? So the overall sector and the industry trend is really important. So how do we analyze the trend of the sector or the industry? Well, there are a few websites you can go to. One of them is sectorspider.com. That's sectorspdr.com. And I'll show it to you in a short while, where with this site, you can actually plot the individual charts of the sectors and compare them to the S&P 500 to see which sectors are outperforming the S&P and which are underperforming the S&P. Another resourceful site you can go to would be Finviz. So at finviz.com, you can select in the tab Groups, and under Groups, you can look at sectors or industries, and you can compare their performance on a 1 week, 1 month, 3 months, 6 months time frame. Okay? And you can also, once again, go to Sector Spider, go to Tools, and use the Sector Tracker. All right? So I'm going to show you the websites in a short while, and before that, let me show you what I'm looking for. Over at Finviz, I click on Groups and I select Sectors, and what I see is I see the 10 sectors and how they are performing relative to each other in the last 1 week, 1 month, and 3 months as well. So for example, you can see that over the last 1 month, which has been the strongest sector? Industrial goods, right? So money has been flowing into the industrial goods sector, and healthcare and technology. So industrials, healthcare, and technology are the 3 strongest sectors in the last 1 month. In the last 1 week, you can see that healthcare has moved up to being the strongest sector. Okay, so would I want to trade a stock? Would I want to buy a stock in the healthcare sector, like United Health and Johnson & Johnson? Or do I want to buy a stock that's in a financial sector like Bank of America or Citigroup, where the financial sector is the worst performing sector, right? So money is going out of there and the companies are all falling down. They're going to healthcare. Where do I want to be? Well, I want to be in healthcare, right? So it's really critical to look at your sector of which the stock is belonging to. Now over here, you can see that you can also select industry, where you further break down the sector into smaller industries. And these are the individual industries. And again, you want to make sure that the stock which you're going long in is in at least the top 1/3 of the industries that are in the list. And if you're going short, make sure the stocks are within the bottom 1/3. That gives you the highest probability of getting the stock right. So how do you find the sector and industry which your stock belongs to? So once again, you go to Finviz, and you can key in the stock ticker of any company. In this case, I'm looking at Apple. And over here, you can see on the home page, Apple belongs to the consumer goods sector and the electronic equipment industry. So from there, I will then click on Groups, and I select Sectors and see where consumer groups lies within the sectors. I want to make sure it's among the top 1/3 of sectors before I go long. Okay, so let me show you how I ascertain the market trend and sector trend. So the first thing I do in my trading routine is I take a look at the trend of the S&P 500. So I'm using this charting software by Thinkorswim, and so what I'll do is I put in the ticker symbol SPX, which represents the S&P 500 index, and I look at daily candles, okay, and I can look at, for example, the 6 months a daily time frame. So it's the last 6 months, and I'm looking at daily candles. So what I want to do is to put in my moving averages, okay. I can click on studies, and again, whatever charting software you use, they will have all these indicators. They're pretty standard in any charting software. So the first thing I'm going to do is to put in my exponential moving average over here. Moving average exponential, double click on that. And for the exponential EMA, I will edit it to 20 because I want a 20 EMA to measure the short-term trend. I'll usually use red for the 20 EMA and put a dotted line. Okay, so that's my 20 EMA. Next, I'll put in my 50 and 200 simple moving average. So I'll look for simple moving average. Where's that? That simple moving average is here. I'm going to click on that. Click again. Okay. So for the first one, I'm going to change it to 50 moving average, and I choose blue for that. Blue. And for this one, it's the 200 moving average to determine the long-term trend. Red. Great. So all I need is my 20, 50, and 200 moving averages. The 20 is an exponential moving average. 50 and 200 are simple moving averages. And I could save my study set as whatever I want to call it. For example, market trend or index trend, right? So I click save. So the next time I do not have to put the moving averages in one by one. I can just simply go to my studies and click on load study, market trend. Right? Click on that and immediately I'll have this trend. Okay. So where are we right now? So as of today, which is the 16th of June, you can see that the price candles are still above the 20 EMA. All right. So it is still above the 20 EMA. 20 EMA is sloping up, so we are still on a short-term uptrend, which means I can look at taking long setups and I will avoid taking short setups. Okay. The price is also above the 50 moving average, which tells me that it's on a strong medium-term uptrend, and again way above the 200 moving average, which is the long-term uptrend. So ideally you want the market to be on a short-term uptrend, medium-term uptrend, and of course if it's on a long-term uptrend, that is ideal as well. All right, so this tells me to look for long setups and avoid short setups.